to the important areas. And you have to listen to me as to what is important and what's not important. Not everything in each of the chapters is important. There are things which are more important than others. What are some of the important things? The definitions, for instance, things which are highlighted. Okay, those are important things. And so this is what I want to do is I want to change things a little bit from this lecture on so that people can really concentrate on things that are important. So let's talk a little bit about the proprietary funds itself. So proprietary funds equate themselves to business type activities. Why would a government be involved in business type activities? Why would a government be involved? Yes. To provide for a fee, right? That's usually what it is. It's for a fee, right? Those constituents, and he mentioned an interesting point, which is constituents, which are customers, can be internal or external. If they're internal, it's called what type of fund accounts for it? Internal service fund. If they are external, then they are enterprise funds. Now, I'm just giving you a very top level view, okay? And then we'll go into the details. Enterprise funds have their financial statements which are shown in the government-wide statements under business type activities, right? Enterprise funds have financial statements which show up in the business type activities under the government-wide statements. Internal service funds don't show up as business type. They are shown within the governmental activities area, which we'll talk about. So even though they are both proprietary funds, one shows up separately as business type, the other one doesn't. And I'll explain to you why that's the case. Okay, so what we're going to be doing is we're going to be studying in this class two things: internal service funds and enterprise funds, what's the accounting issues and what the financial statements are. Very straightforward chapter, though I've told you that in the past too with others. Okay? Let's talk about why we use proprietary funds. Now, I want you to read this sentence for a moment and tell me what the important pieces of this are. Management of activities. It allows you to manage things properly. How? By comparing the cost of providing that services to what you charge for those services. So to compare benefits and costs. Important slide, because that's the reason why we use proprietary funds. We use them so that we can know, for instance, what does it cost us to provide a service. Any word of profit in here? No. So basically, if I asked you, most governments want to provide services on what? A break-even basis, right? On a where something, there's no profit involved, cost equals their revenue itself. So the key words here are management, cost reimbursement, okay? And it could be to the same government, which is an internal service fund, or to the general public, in which case it's an enterprise fund on a user charge basis. This is the accounting equation. Assets, it used to be just assets plus minus liabilities equal net position, but as I said to you, there are these two new elements, deferred outflows and deferred inflows. This is something you have to, for your little reading later on. I want you to again read the meaning of deferred inflow and deferred outflows. What's an example of deferred inflows? Deferred revenue. And what's an example of deferred outflow? Well, if you, prepaid items, yeah. Okay, prepaid, any kind of prepaids come to that. So deferred inflows fall under the liabilities and deferred outflows fall under the assets. That's why we've seen this. Okay, and we'll talk about the net position. Why we have, net position broken down into three areas: unrestricted, restricted, and net investment in capital assets. We'll talk about that in a moment, okay? So these are the types of things we started off with. One, accrual basis, long-term liabilities and assets are shown. Notice budgets are normally not used, especially fixed budgets. Flexible budgets, yes. Does everyone understand the difference between flexible and fixed budgets? Flexible are based on what? Volume, right? On number of items. Fixed are what? Period. Okay. Depreciation expense and accumulated depreciation are recorded, and they follow the same guidance as private enterprises do. In fact, it's interesting because, FASB pronouncements can be followed by those who run proprietary funds. So for instance, all FASB pronouncements, as long as they don't contradict GASB pronouncements, they're allowed to follow them. And I think the date was 1989. You'll see that mentioned in the book. All the standards through 89, they could be followed. There are three statements: statement of net position or balance sheet, statement of revenues, expenses, and changes in fund net position. What happened to expenditures? You see the word expenditures here? Because expenditures is associated with what? Modified accrual basis, no expenditures. Proprietary funds only expenses because it's accrual basis. Okay, everybody got that? And then a statement of cash flows. We never had statement of cash flows in the governmental funds. These are the three statements you need to be familiar with. They look very much like a business enterprise, but there are some differences, and I'll talk about what those differences are, and you should understand them. Okay. First of all, classified statement is prepared. That means, you show your current assets in terms of liquidity, and then you go up higher, just like your normal balance sheet that you see for a business enterprise. That's the classified format. But more importantly is this next item. Net position is divided into three areas. Net investment in capital assets. Now let me explain to you why this is done this way. Why just not have one net position number? Assets minus liability equals net position. Because what you need to know is, and people who purchase those services from you need to know, if you are charging too much or charging too little for the service. So for instance, let me give you an example. If I were New Jersey Transit Corporation and I had $1 billion of net position as a as a customer, what would your reaction be if you have a large net position? You would say you're charging what? Too little or too much? Little problem, right? With that first concept, which was what? You need to make sure that you charge approximately what it costs you. But by doing that, that's not enough, because assets minus liability equals net position. And net position can represent your investment in capital assets. It can represent things which are items that are restricted for some reason. Okay? And for that reason, that very first item, net investment in capital assets, need to be shown separately. Now, let me see if there is a I think it's there's a nice illustration, so I can show you the it's on page 273. Okay. Notice this. Net investment in capital assets, right? It's broken down, restricted for debt service and unrestricted. Unrestricted, we all understand what that means. But what does net investment in capital asset means? It means the total amount of your capital assets minus your accumulated depreciation minus any amounts you've borrowed to acquire that asset. So, for instance, if you have assets worth $10 million, your accumulated depreciation is 3, what do you have left as your net assets? 10 minus 3 is 7. If you borrowed $2 million to purchase those assets, what is your net investment now? 7 minus 2, which gives you what? 5. That's your net investment in capital assets. So next item you should write down for yourself is know how to calculate net investment in capital assets. It's your total assets minus the depreciation minus any debt that you incur to acquire that asset. The second part of the pie is restricted for debt service. Okay? By the way, can anyone tell me what the calculation here is to arrive at 1.231? Let me see who can get this. How do I come up with 1231 based on my total assets that I have here? 2,976,000. How do you think I came up with this number? Or the book came up with this number? 2,976,000, which is the net assets, minus what? Minus your bonds, which gives you this number. So it's 2,976,500 minus 1,744,700. Is that right? Yep. Equals what? 1,231,000. You got that, right? That's an illustration of how we calculate that. Let's go to the next one, restricted for debt service. Now what happens is sometimes when you borrow money, you need to put money aside for debt service for a year or 2 years. Or you might get a grant which is restricted for a certain purpose. You have to recognize that restriction and show it as a restriction of net position. Now, let's try to see how they come up with restricted for debt service. Now, that also contains items such as customer deposits. So this is what I'd like you to do. These are restricted assets, right? 562,600. Everybody see this? 562,600. What other things are restricted? 562,600. And then there is liabilities, customers' deposits, which are also restricted of 23,700. 562,600 minus 23,700 gives me 538,900. Giving you an example of how we come up with restrictions. And you might say, now I'm really confused. What is this whole thing about restricted and unrestricted? Now, many years ago, I don't know if this is still valid. If you had to get a telephone line, for instance, or you got a new water utility meter, you had to put some money as a deposit to make sure that, you just didn't take off and they were stuck with unpaid utility bill. So you put some money out. It's no different than paying rent up, a security deposit. It's a security deposit for a utility. That goes as restricted asset, which is what? A restricted liability for the amount that's owed to you, and a restricted asset which is represented by cash. So if you gave a utility $200 because you just signed up, it would show up cash $200 and liability $200. That's the restriction. So these are the three areas that, and by the way, unrestricted is anything that's left over. You know this number, subtract this, and it will give you the unrestricted portion. I think we talked enough about that. Okay. By the way, there's another thing which I wanted to tell you about, which is actually I had this slide up earlier. Was it page? I think we'll come to that. Page 45. Okay. These are one of the types of proprietary funds which are enterprise funds. What do you observe here, by the way? Look at the columns. The different columns. And what's the column before the total? Non-major. Does it mean that enterprise funds also follow major fund accounting? Yes, they do. It seems like it, right? And they follow the same rules as the governmental funds. Remember the 10 and 5% rule? Exactly the same for enterprise funds. So if you had more than one enterprise funds, you'd have to list them depending on whether they are major or non-major. Okay. All right. Going back to any questions, by the way? If not, we'll go to the next item, which is the operating statement itself. Now, if you were, you remember it talks about management of making sure that your revenues are sufficient to support your costs. What would you be interested in the income statement? What would you want to know on the income statement end? You'd want to know that your operating revenues cover your operating expenses. Would you want to mix up your non-operating with the operating stuff? No, because then you wouldn't know, right? If you understand that, you've gotten the key to understanding the operating statement, which basically says lump all the operating items together and lump all the non-operating items together. Don't mix them up, because you need to know what's operating from what's non-operating itself. Do you see the message here? Check the microphone connection. That's not a good. Okay. All right. Let's just take a quick look at our statement, because the best way to show you is the statement itself. I want you to take a look at this statement and tell me what you think about it. This is on page 284. Just take a moment and see what you think. So we talked about the balance sheet, right? The statement of net position. I mentioned to you the classified format and this breaking down the net position and the restrictions. Okay, so everybody get the point here? What do we see? Are the operating items all together? Yes. And what happens to the non-operating items? There, yeah. Somebody had a question? Okay. So, and then the non-operating items are set out separately. Everybody see the, and that's all it is. It's just a matter of lumping together operating with non-operating. So looking at this, how did they do as far as their operations go? How would you read this statement? Did they cover their operating expenses? Yes. And even after their non-operating items, they were able to still have a surplus. Now you might say, isn't there something wrong with having utilities having surpluses? No, they might need it for capital investments, for instance. They might need it for working capital, for instance. Okay. Now, the next statement which I want to talk about is the cash flow statement. Okay. And the cash flow statement, how many of you have ever prepared a cash flow statement? And as you know, it's not the easiest thing to do, right? No. And the statement for enterprise for proprietary funds is even worse, because the statement that you've prepared, how many different methods for preparing cash flow statements? Indirect and you used which method? The indirect method. But GASB requires direct method. Instead of 3 categories, you now have 4 categories. Okay? And I'll tell you an interesting story. Many years ago, when we had to do a cash flow statement for an enterprise fund that I was responsible for, we could never get the numbers. No matter what we did, it was the most famous accounting plug you'd ever think of. You know, you couldn't figure it out because the direct method requires you to analyze the change in each of the accounts. And you have to be careful and you have to understand that. And so the first point I want to tell you is I'm not going to ask you to prepare a cash flow statement on using the indirect method itself. But I expect you to understand the 4 categories. What were the categories? You remember those categories? There was the cash flow from what? Operating activities, right? That's pretty easy, right? Those are what? Your sales, your expenses, things like that. And then there were cash flow from what? Investing activities, right? Now, what happens with governments is that we divide our capital into 2. Capital and non-capital activities, because we need to recognize things like grants and let me just go to the next so you can actually see this. Here are the primary differences. See, it takes the financing activity and divides it into non-capital and capital. And you'll see things like interest expense on long-term debt as a capital and related financing activity rather than an operating activity under FASB. So what I want you to do is I want you to be able to recognize the types of transactions that fall within each of those categories. So for instance, here there's an example of interest expense. That's shown as is a capital and related financing activity rather than an operating activity. We're used to interest expense being operating, right? But it doesn't show up that way. For instance, these are really the primary difference themselves. Okay. There is an example of it in the book. Should take a look at it. I don't want to spend too much time here on this. Okay, let's just talk quickly about the internal service funds. So